All right. Welcome to Kirk Spano's Fundamental Trends. Blue Mound Asset Management is my investment advisory. And over at Seeking an Alpha, we have Margin of Safety Investing. So the majority of my publishing is over at Seeking Alpha. Seeking Alpha now. I'm still at a few other places, and I'll be syndicating to Market Watch and Talk Markets and a few others here going forward. I am bringing on a copy editor and a marketing person just to do some of the things that take up some of my time, and I'd rather be doing the research. So let's talk about this week's big article. Facebook's problems will be expensive to fix. I don't know how many of you watched Mark Zuckerberg in Congress. I watched about 5 hours of it and then read a lot of the answers back. Um, Back when Facebook was crashing after their IPO, I was one of the few voices out there on Market Watch where I told everybody that they should be buying Facebook shares down in the 30s and 20s. And this way back May of 2012, the stock was getting crushed. Um, I told everybody you ought to be buying it. So I'm not a Facebook hater, but I think I'm a realist. And here's some things that I think about Facebook that I think will be important for investors going forward. The first thing is that I don't believe that Facebook is impermeable as everybody believes. I think that technology being what it is, it wouldn't be impossible for Facebook to see some fraying around the edges with more family-centric services. And I believe that a lot of people stay connected to their friends on Facebook as well as their families. And I think that there is the potential that essential monopoly that exists right now could be busted up a little bit by niche players who uh, create smaller networks that are for your closer friends or for your family versus the extended networks of people that most folks have on Facebook. For example, I don't talk to a lot of folks that I went to high school with, but I'm probably friends with 30 or 40 of them on Facebook. Do I want them knowing every detail of my life, or do I spend a large amount of time on Facebook trying to segregate people out into different groups? It would be easier if I was able to just tell the 25 people that I talk to regularly or 30 people that I talk to regularly, relatives and, a dozen closer friends, hey, this is the app that you ought to be checking out for me. So I don't know if that will happen. I've taken the time to break up my Facebook friends in the groups. I don't know how many other people are, but what's going on at Facebook really, I think, is going to wake up competitors. And ultimately, I think you'll see some unique things come out. We already know that user growth has slowed. We also know that people are spending less time on Facebook. What's about to happen now is that their revenue generation machine is going to get hampered because they're going to have more regulation, whether it's self-imposed or from Congress. I think it'll be both. And I think that the value of their advertising is at best going to flatten out, right? Maybe they don't lose margin very much, maybe just a little bit. But I believe that you're probably going to see Facebook's earnings growth rate slow down significantly. That doesn't mean their earnings won't grow. They're just not going to grow as fast as they have. I showed that chart in the article. I mean, this is a pretty amazing chart. I mean, take a look at what happened with revenues, just since they went public. I mean, that's eightfold. And the earnings went from zero 15 billion, 16 billion a year. This jump here, I mean, just look at that. That's an exponential curve. I believe it's going to start turning into an S, right? So instead of going up, 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 up and away, it's gonna plateau off, and it's going to be an S curve, right? And that's pretty much how every business works. They're not going to be immune to the same business cycle that everybody else has. Their exponential growth is almost over. It might be over already, and this is going to keep going up, but at a much slower rate. And the curve, instead of bending up, is going to bend over. All right, so I don't know if there's any questions about Facebook, but I did take it off the very short list because they don't pay a dividend. So companies that are far along on their S curve that don't pay a dividend have very limited value, right? Because their growth rate is slowing and they're not returning capital to shareholders. And the buybacks at Facebook, offset the stock-based compensation. But I think that ultimately employees at Facebook are going to become, I think they're going to have more challenges in the talent pool now, because the folks who go to work for them know that the big money was to be made owning stock options, and that probably won't be the case anymore. So that means that their cost of hiring really good engineers and other people is going to go up because they'll have to do it in cash. So I don't have hate for Facebook. I just think that at the moment, and until they decide to start paying a dividend or buy back an awful lot of shares, there's limited appeal to it as an investment, and it might be that way for years. A lot of the things that Facebook has to do are going to be expensive, and so as they move into other ways of making money, remember, they're buying their way in for the most part. I mean, they didn't invent online entertainment. You got YouTube out there, and you got Netflix out there, you got Amazon out there. There's an awful lot of Twitter. There's an awful lot of entertainment avenues. So while, hey, let's watch viral videos for a half an hour is one thing. The reality is you're not, not making popcorn, sitting in front of the TV with somebody and watching 3 hours worth of Facebook. For that to happen, they'd have to buy somebody that, like Netflix, which would be expensive, or some smaller providers, which would take time to cobble together. It's just going to be difficult for Facebook to maintain the curve. Yeah, I should have left that chart up. It's just going to be difficult for Facebook to maintain this. And it's happening, and it happens for everybody. I mean, take a look at what happened to GE. GE just got destroyed the last decade, and really is taking it in the shorts now. So that's the Facebook. Let's move on to some other things. Let's go macro. The market got shooken up a while back. I wrote this article a few weeks ago. The market told the president to stop it on the trade tariffs. And I made the point that the president would have to back off and cut marginal deals. So that seems to be happening. He's talking about cutting a deal with China. Wilbur Ross talked about something that I put in another article we'll look at, is that to cut the trade deficit by 50 billion, which China offered to do, they're going to have to figure out things for the United States to be able to sell into China. So China is talking about cars and some technology and some other things that we can sell to them. But one of the big ticket items is going to be oil and gas, natural gas in particular. So, keep an eye on the natural gas market. It's one of the reasons why I recommended Antero. I hope you all liked my Klingon example here. The article is only read about 5,000 times, so I really hate to waste a good Klingon reference. but we talked about Antero Resources. And if China agrees to buy several billion more dollars worth of natural gas every year, liquefied natural gas, now you're taking a look at some companies out there that are going to make a lot of money. I think the first one that people think about is LNG, Cheniere. And their contracts are long. I think they're going to be a player for a long, long time. They're going to make money. I don't really have a great grasp of what the total return potential is there. So I do need to do that analysis again. I haven't looked at them in years. And since they had that one CEO that was basically eluding the company. But I think the producers in the Marcellus and the Utica are going to do very well. Excuse me. And I think that the gas that gets captured from the Permian is going to add to the bottom lines of a lot of those companies. So one of the companies that I think is going to do well is Kinder Morgan, largest natural gas pipeline company. And somebody brought up Viper Energy Partners. And again, I haven't done all the research on Viper, but they are being converted from a MLP to a corporate structure, which is what Kinder Morgan did several years ago. And, they're, I think, came out of Diamondback Energy. And they're getting some interest by the insiders, and they have momentum. So Kinder Morgan's more of a value play. Viper has a lot of momentum right now. So, pick what you like. Maybe you like a little bit of both. But I think that you're going to see some of these MLPs do well because their pipes are going to fill up, and they're going to get favorable deals on some development because there's going to be a need for more natural gas pipes. And the companies that can get good capital deals and higher toll rates should do pretty well. And the companies that operate in the Permian and then out to the Marcellus and to the Utica should do well. So Kinder Morgan, Viper, I think are definitely companies to take a look at. You know that I own Kinder Morgan. I think that they're going to deliver on the promises that they made. I know there's a lot of hard feelings about what happened during the oil crash and the natural gas crash. I mean, remember, there was record low prices on natural gas. Companies were going bankrupt. They couldn't pay their rates. Chesapeake had to renegotiate, and they're huge. So, Kinder Morgan didn't double cross anybody. They just ran into hugely bad business conditions for a couple of years. And now they're on the way back. And they have assets that just can't be replicated. And now, interestingly, Canada has said that they will partner with Kinder Morgan on the new pipeline up there, the Trans Mountain. So they're going to get some help with that, which I think is a huge positive. I mean, I think it's a monumental positive. So when you think of investing and we talk about core four, what are the things we're looking at? Secular trends, governments and central bank policy. So if Canada is going to help Kinder Morgan, now all of a sudden you have the government on their side. Versus in the United States and in British Columbia, you have a lot of the governments fighting pipeline development. So if suddenly you get the federal government in Canada to help them, now you've got some good things going on. All right. Ultimately, I do expect positive surprises on the trade side. So I'm not hugely negative, but I do think that you should be cautious because we could be wrong on this. Okay. By the way, these articles that I'm writing on Seeking Alpha, they now on the bottom of the article have a like button. It's just teeny tiny. But when you read these, if you could click that, I'd appreciate it for a couple of, and leave a comment. I'd appreciate that. One, I want to hear from you. Two, I want to know that you like the article. found it useful in some way. That's all. I mean, you're not saying that, hey, it's the greatest article ever written, but if you found it useful in some way or got you thinking, click that, because Seeking Alpha is toying around with the idea of giving quality scores to these articles based on quantitative data, people posting and people clicking this button. And I'll tell you what, some of the articles I've written have generated hundreds of comments, and tens of thousands of views, but they want to cut my pay by 12%, and I don't make much money in these articles. Between 75 and 175 bucks per article. These are not. You see, I write one or two a week. I'm not looking at these as primary income, but nobody likes to hear they're getting a pay cut. So yeah, hit the like button once in a while. All right, so we're done with Facebook and trade. We spent a lot on these topics, the trade topics in recent weeks. Let's talk about what I published yesterday. Today. The S&P is about to rally to 3,000. I figured this would get a little bit of attention. I've been cautious about the intermediate term of the market. In the short term, I've actually started trading more in the last year. I don't like to trade much. I like to hold most of my investments well over a year. And the reason for that is that swing trading is very difficult. Day trading is probably easier. But swing trading from quarter to quarter, month to month is just tough because you never know what's going to shake out in the very short term. And particularly with this presidential administration and its forays into social media, every now and then you get a shock to the system. But I've actually been pretty on it. I did tell everybody 2 weeks before it happened that volatility was about to shoot up. I only made 30, 40, 50, 60% on those trades in that month. But I do know several subscribers told me that, they bought those calls and they held them for a few days longer than I did. And those few days longer were some of those giant volatility days. And I know people made 2, 3, 4, 5, 600% on some of those trades. So, congratulations to some of those folks. I mean, they killed it. I think that we're going to see the stock market rally up to around 300 on the S&P, 3 on the SPY, 3,000 on the S&P. And that's in line with Jeremy Grantham's views, which, I should have linked his letter here, but Google Jeremy Grantham and melt up. In fact, we can do that together here real quick, and I'll show you. He if you don't know who Jeremy Grantham is, you need to. Let's see here, 3 days ago. So let's see here. Do I have a subscription to this one? I don't know. Economist, I do. He's called both the last two crashes. And he's been talking about a melt up in the market this year. And I think that he's going to turn out to be right, although the odds of the melt up have fallen because of the trade issues. If we get over the trade issues, we're probably going to have that melt up. Although the thing that's going to throw it off, and I haven't read this article yet, the thing that would throw it off would probably be the Federal Reserve. So while I think this is going to happen, I do think it's going to be volatile, and you have some things that you have to keep an eye on. You're going to want to keep an eye on the cryptocurrencies because the correlation has been pretty interesting, right? So you see these rallies, cryptocurrencies spiked and then started jitterbugging down. But look at that. Isn't that interesting? Why did the cryptocurrencies do the same thing as the stock market? Right? That's an important question. Now, they're starting to diverge a little bit. So here's my question. If, sorry about that, it's been lingering. If the cryptocurrencies start to rally And I think you're going to see a rally because people are getting in, because I think it's a value trap, right? I think people are starting to get in to cryptocurrencies because they're thinking, oh, well, it came down. This is my chance to get in there and be a long-term investor in Bitcoin or Ethereum or Ripple or Dash or Litecoin or one of those more speculative, one of the other. They're all speculative, but some of the smaller ones. And I think you're going to see that. So I think, there's a new section at Seeking Alpha about cryptocurrencies, and I'm going to write a couple articles right off the bat because I do have some feelings on the cryptocurrencies. I do hang out with some blockchain engineers from time to time, and I've spent the last year or so getting to know this space, and it is a tough space to get to know. So, I think if we get a rally in cryptocurrencies, that'll be a signal of euphoria, right? So that's the thing that me and Mark Yusko talked about last summer. And he thought that we were way up here last summer, and I disagreed. I said, I think we're around enthusiasm last summer. He thought we were in a delusion. It turned out, it looks like I was right. I mean, the market went up for another 6 months, 7 months, and then we actually did get the first one of these, and then that, but they could just easily be over here. There's nothing to say that we can't get more to the upside. I do think we're going to set new highs one more time. I could be wrong, but I'm pretty sure we're going to. If this is in fact where we are in denial, we'll get this return. Okay, we'll get this, and then maybe we won't get that. Maybe we won't get the new highs. So we have to keep an eye on it. There's nothing set in stone. We have to play it by ear, follow the technical signals, follow the quantitative signals, and just know that, the stock market is overvalued right now, but it's much less overvalued today than it was in January. So there are some things that are worth buying, and as I've said, you have to be selective. I think it's hard to buy indexes. On the next rally, I'm going to write an article that talks about what index investors are going to face over the next several years, maybe 5-6 years. And I don't think indexers are going to be very happy with their investment methodology starting very soon. So, this next rally, they'll feel good. But then after that, they could have a number of years where they don't make any money. All right, so what do I want to buy if I think that we're going to get a rally in the stock market? I want to stay with the companies that we really like. I want to stay with the secular trend leaders. And I don't own all of these, but I know that folks are looking. Some folks have a lot of cash and they're looking for things to put money into. Cisco is on the right side of communications. Micron is on the right side of computing, edge computing, and just everything. DRAM isn't going to be in surplus for at least a year, maybe 2, maybe 3, maybe not for a long, long time. PayPal, that's a company that I was telling people to buy at the IPO, and on this little pullback, I made it one of our focus stocks this month to try to get a piece of. So everybody should have bought a little bit of PayPal. When I put out the focus lists, every month I say, okay, this is a group of stocks you got to really focus on this month from the very short list, and I'll put 8, 9, 10, 12 stocks. Hey, these are the ones to watch. If I put a stock on that short list, you better pay attention, because that means that, A, it's a good company, like all the companies that we're following, but B, there are financial reasons, there are technical reasons and quantitative reasons why, hey, this is a stock that came back to us a little bit or accelerating. It could be either way. So either you want to jump on a trend or you want to get ready for a reversal. And PayPal came down near 70. I told you guys to buy it at 72? A week later, it's 77. I mean, it's just, this company could very easily be $200-$300 stock in a few years. They have some pretty interesting things going on. They're going to incorporate blockchain. I think they're going to beat the banks to doing wire transfers that are instantaneous. I mean, everything's already fast, but I think that they're going to be the leader in in instantaneous wire transfers. And ultimately, going back to the cryptocurrency talk up here, the only cryptocurrencies that I think are going to survive, where did I, is that this article even? There we go. It's in here somewhere. Well, there we go. The only cryptocurrencies that are going to survive, in my opinion, are the ones that the banks will accept for instantaneous transactions. And they're not going to accept many. And they might even create their own. So ultimately, I do think most cryptocurrencies are going to zero. And I know people are going, oh, it's going to go to zero. Yeah, it's going to go to zero. These are inherently worthless items, or they're worthless. So when somebody runs around saying fiat currency, I just want to, ask them, fiat, isn't that a car? Everything is based on fiat currency and what backs it. For example, the dollar. What is the dollar really backed by? And people go, nothing. They took it off the gold standard. They're wrong. And they're not that smart if they're saying it, or they're just ignorant or misinformed, or they're scared or something. Look, the dollar is backed by the real productive capacity of the United States and the value of the already created assets, the already built assets. The dollar is the strongest currency on the planet, by far. I said this back in 2012 when everybody said it was going to hell. Look, the United States has natural advantages of geography, of military, of resources, of government, rule of law, education, a workforce that believes in work. At least 80% of us do, and it's going to be very hard for any other big economy to replicate what the United States has. Japan's not. Japan's going is got big problems, and they're not that big. Europe has got major problems that are going to last for a very long time. Could they become the United States of Europe? They could, but they won't. Russia, forget about Russia. They have generations of fixing to do. China's going to, and I wrote about this way back in 2010, China's going to end up being a co-reserve currency, but they have a lot of growth pains to go through. And ultimately, and I just got off the phone with a subscriber and a new client on the investment management side, and I told them of the major currencies and the major markets, the United States and India are where you want to look. So, there's other frontier and emerging markets that I'm going to like, and I'll talk about Mexico in coming weeks. But this whole fiat currency thing, look, man, if you're buying into the whole fiat currency argument, you just don't understand money. Go take a money and banking class. The governments and central banks of the world are never, ever, and read my lips that without looking, these currencies, they're all going to zero. These are the ones that are going to get crushed. There will be a handful that survive because the banks adopt them for wire transfers and instantaneous transactions. And those will be the only ones. In any case, that was the tangent off of PayPal. Visa's going to get in on all this too. I show the chart of Visa. I don't know how much longer this can last. But I mean, you want a good chart, beat that, right? I mean, it's up about tenfold since the crisis. Every time it pulls back or has a plateau period, it takes off again. We're going through one of those now. And they're going to be on the winning side of whatever comes down the financial system. And they don't have to stay with credit cards exclusively. They can get involved with Apple Pay and everything else. So just understand, Visa is going to be a winner for a very long time. I don't own it, right? It's a little too expensive for me. If it came back to 110, I'd probably, the 200-day moving average, I'd probably look at it. If, okay, if there's not something really bad going on with the economy. So at the 200-day moving average, or just a little bit above the 200-day moving average, is where I start to look at Visa and go, do I have a spot for that in my portfolio? No, I prefer PayPal. I prefer Micron. But Visa and Cisco are companies that at the right price, basically 200-day moving average without a bear trend. And I'd look at those. So do you understand when go ahead and post in the chat. When I talk about how I'm doing this trading, are you starting to wrap your head around this? Have I explained it well enough? Just because it has this great trend doesn't mean you buy it all the time. And if you're reading Motley Fool, they'll just say buy it. They will just buy it because it's going to go up eventually. I like to get these added $10, $20 margins of safety, right? So if I can buy this at 111 versus 120, who's doing better, right? So you can see that it hits the 200-day moving average once in a while, and then it just pops right back up eventually. So I do like to buy things at the 200-day moving average, especially when the 200-day moving average levels off a little bit, right? So that's what you keep your eye out for. If this turns over a little bit in the next year or so, take a look at Visa, and keep your eye out for news on them getting involved in blockchain, because it's going to happen. And that's why the cryptocurrencies won't survive, right? The financial institutions are going to figure out their own way of doing it. And, some of the cryptocurrencies, I guess, could be bought, but yeah, I don't even really know how that happens. All right, so and then the other thing we want, other than to be involved in the big secular trends, is, at least for now, until the next recessionary event, we want to be in inflation-linked investments, because even though the Fed's tightening, they're probably a year away from really doing damage. Franco-Nevada, a company I've known about a long time. I only put it in here because I know that people want gold ideas. I'm not a big gold guy. I think that most gold is it's more valuable than a cryptocurrency, because you can make jewelry out of it, and Apple uses it for the iPhone. But the reality is that there's so much gold versus what we use it for that if the central banks ever just said, hey, let's all sell our gold into the market, the price would drop to $400 or $500 an ounce, which is way below what it costs to produce more. So I like the streaming companies a little bit. I've taken a look at Barrick over the years. I like the CEO. I think he did some good things there. But mining is just a tough business. So, unless the price of gold really goes up a lot, which would only be temporary anyway, because it always comes back down, you're probably not going to see anything other than very moderate growth in the gold space. This company, however, has a couple things going for them. Very good capital structure, and they've expanded into some oil and gas projects. So if I was going to buy something in this space, Franco-Nevada would be the one that I would buy. And I think you'll see an increase in dividend with them and a little bit of growth. But again, I'm not in love with any of the gold investments, but I know that people want them. I think this is probably the least risky that offers some appreciation tied to gold. It'll be levered to gold, so it probably does better than actual gold. If you want a gold fund that holds physical gold, GLD is out there, but I like the Canadian one that owns a little silver as well, which is CEF. That's out there as well. Again, I'm not big into that, but I know that some people want a few percent. All right, Nutrien. I've been pounding the table on Potash Corp since they announced the merger with Agrium. And something to keep in mind here, I wrote about Potash Corp back in 2011 or 12, probably 12, back when Putin put the screws to Uralkali, which is the big potash producer in Ukraine. And I said that Potash Corp was going to have several years of a tough market. And in fact, they did. They had 5 years of a tough market where potash prices came down. There was overcapacity. And now that whole cycle is ending. And now that potash and agrium have merged, which I'll tell you what, they were operating as an oligopoly anyway, up there in Canada along with Mosaic. But now that they've merged, they get a lot of good vertical integration for distribution, and they are holding back on expanding their production. So essentially, that'd be like Exxon pulling back on producing, or Saudi Aramco, OPEC, pulling back on producing oil, right? So you've got this giant producer that's not producing as much potash as they could. The balance in the market has occurred. It's already there. The pricing just doesn't reflect it yet, but you're going to see Nutrien drift up. Their dividend's pretty good. They're about to get a big payout from selling their 1/3 stake in SQM, the lithium producer down in Chile. Nutrien, I think, could be $100 stock, as the price of potash goes up and as they realize all this cash coming in, which they're going to use for share buybacks and dividend increases. They've already announced it. So I think this is a pretty darn good spot to buy Nutrien. If you are legitimately a dividend growth investor and you're not buying Nutrien because, oh my gosh, it hasn't gone up in a while, then I don't really think you're a dividend growth investor. This is near the top of my list. Another one for dividend growth investors is Occidental Petroleum. I've been pounding the table on them for a few months. I mentioned them first last summer. They had the big run up. They've pulled back here in the last couple of months, and they're starting to run up again. This is a stock that could go well over 100. And here's the secret sauce, right? Here's the catalyst that nobody pays attention to. They have expanded their export facility down in Texas. And they're going to be able to take I forget what the super tankers are called, but they're going to be able to take the bigger oil tankers, the ones that can go across the Pacific Ocean. Okay. Start putting pieces together. Trump wants to sell more oil and gas to China to reduce the deficit. He's been talking about that for a year, 2 years. And these guys suddenly have super tanker capability. Right, so this company is going to be one of the winners. They're the biggest producer in the Permian right now. Although the merger has just happened, might have knocked them the second. I have to check on that. So finally, one that I've known about for years because I'm up here in paper country. Wisconsin. A lot of Wisconsin's wealth is from the old paper mills. So I kind of understand this industry. Westrock, they make paper and corrugated packaging and things like that. Things that you probably touch almost every day. Very, very strong balance sheet. They pay a dividend. Their payout ratio is only 24%. So the payout is not only secure, but it's likely to grow. Do they get hurt on their growth because there's less paper in the world? You would think because that we're using less paper, but the reality is all this paperless society uses more paper. And I can tell you, in the financial industry, we've been trying to go paperless, and you just have different types of paper. So while we can do an application online for Interactive Brokers, I still have to have physical copies for my regulators. So I'm still printing out what used to be a 2-page triplicate form, 6 total pages. I now have to print that out in PDF with all the disclaimers and everything else instead of printed on the back, and it ends up being, I think it's a 16-page. So it went from 6 pages for the application to 16 pages, but now it's paperless. Go figure. All right, let me take a look at some questions. I'm pretty much done for the day. I'm going to talk about oil a lot this week. I got 5 articles teed up for oil, and I'm going to have one article for you that is specifically on how to trade the oil, and the natural gas. So I'm going to lay out, and this will not go public. I'm going to lay out an entire trading strategy for the oil and gas for the next few years, utilizing if it's in this article, I'm going to really explain this chart that I created, right? So I took the EIA chart, and I want to really explain this blue line and why it's important in relation to the black line, and why I see it overshooting out here in about a decade, and then why I see it crossing back over in a decade after that. And will the years be perfect? No, the years will not be perfect, but the general theory is going to be right. I mean, the odds of it not being right, if I'm not right about this curve for the next decade, then we just get out of the oil trades. But I'm pretty certain I'm going to be right. I think the supply is going to be controlled and it's going to be held under demand. Then when demand finally turns over, when EVs finally make a difference in a decade or so, then they'll overshoot. And why will supply overshoot demand when the EV starts to take hold? Because at that point, the oil producer is going to fight back, right? They'll want the price of oil to be right down at the margin so that they can make something for longer. But let's worry about that in 10 years. For the next 10 years, supply should be held under demand, again, until the demand curve really turns over. And I'm going to talk about how we trade this for the next decade, and where the big money is going to be made, and how we can generate probably some very fat dividends. When a company, or in this case an entire industry, and it's what is called runoff, these businesses are running off, right? They know that they're not forever businesses anymore. So they're going to run off their business, which means they're going to start really returning capital. If we can buy shares of future capital at a discount today, that's what we want, right? If we can buy $10 bills for $7, why wouldn't you do that all day long, right? So that's what we're getting with some of these energy companies. That's why my allocation to energy is 25% of my portfolios. I'm a quarter in energy right now. And I've been down to 18%, for a month or two, because I knew that we were going to have this little pullback. But for a lot of folks, it doesn't pay to even trade it. Because if you're a trader, you have some of that instinct, and you have some of this technical know-how, then great. I throw those out there. I just mentioned them, but the big trade is you want to be an owner of oil and gas, because oil is still in demand for another decade. Demand is still going up for at least 5, 6, 7 more years. And the natural gas market is expanding again. And it's going to expand a lot because you're going to have solar projects coming online, but they've all been delayed 2-3 years. The one that Saudi Arabia, which is going to be gigantic, just announced they're not even going to start building until the 2020s. The short-term solution for climate change, and I know not everybody believes in that, I'll just tell you again, something else you're wrong about. Climate change is happening. We are part of the problem. And even if we are wrong, it doesn't matter. Why? Because 91 countries signed not 91, it was 100 and something, right? 170, whatever the heck it was. All these countries, with the exception of a few, are part of the Paris Climate Change Agreement. They're changing laws, period. They're changing laws. They're going to get rid of coal. And part of that coal generation is going to go to natural gas. Most of it will actually go to alternatives. However, some of it will go to natural gas. So demand for natural gas is going to keep going up. And it's going to have a similar curve here where supply is just a little bit under demand. And that'll be firm for prices. I think you're going to see $3.50 to $4 natural gas per million BTUs, MMBTU. And that's coming probably by next winter, would be my guess. So this is, again, a good time to get into Antero. And I'll tell you what, if you want a major, buy Total. Total is really the only oil major that I really like, oil and gas major I like. Why? Because they have that big hunk of sun power. Total is a really good diversified company. I know there's people out there that really like Royal Dutch Shell. Yeah, I get it. I get why you'd like Royal Dutch Shell. But I prefer Total. I think they have more things going for them. Chevron and Exxon, you should be swapping out of those. If you own Chevron and Exxon, will they go up in the next several years? Yes. Will they go up anywhere near as much as Total or some of these Permian plays? Not even close. So the report on how to trade this is going to be pretty comprehensive, and I'm going to mention it in all of the articles I write next week. So it'll be, teased. Hopefully get us our last couple hundred subscribers. All right, quick look at the questions, and then we will roll out of here. I'm flying to Vegas, 27th of June. I might have time on the 28th. I'll try to schedule my flight out late. Do you believe tax reform will pull many manufacturing jobs from China back to the States? Nope. Here's why. So most of the jobs that went to China and overseas and to Mexico had nothing to do with their lower wages. We know that 80% to 85%, depending on whose study you read, whether it's Stanford, Harvard, whoever, they've all done these studies, Bloomberg, 80 to 85% of the jobs in manufacturing that disappeared had to do with what? Technology. So was there some migration of jobs overseas? Yes, but it was temporary. They're even losing those jobs over there now. Ultimately, the cash coming back right now is good, and here's why. It's not going to bring back a lot of jobs on the manufacturing side, but it is going to lead to capital spending. There will be some trickle-down effect with all the dividends and buybacks, although that's minimal, right? I mean, 20% of the people get all of that benefit, and most of the benefit goes to 1 or 2%. But there is going to be an increase in capital spending for the next year or two. And to the extent that we bring some things back, and the fact that we're going to have the slow growth forever economy, and you need to read those pieces, the world is never going to grow the way that it did after World War II, the financial crisis. Never, ever again. We don't have the population growth rate, and we're developed now, right? We're further along on the global S curve than we were 70 years ago. So growth is going to be slower. Because of that, you do want to try to repatriate now ahead of that. Because when it hits, when the next recession hits, and we start to have currency resets, we get helicopter money, and they screw other things up, it's going to be important to have productive capacity at home. Because global trade will get disrupted. It's what happens. We're seeing it now. Globalism is very, very good for standard of living. However, ahead of the next recession and slow growth event, it's important to basically anchor some of this productive capacity back at home. So to that extent, in my opinion, President Trump is right to be playing hardball on this stuff now, because eventually it's going to matter. And Apple building a plant here, or the car companies building a little bit more here, right? It's all marginal stuff. It's nothing big, but it's marginal stuff. It adds a little bit here, a fraction of a percent there, and those little things will help. And again, we are going into the smart everything world as well. So not only the slow growth forever world, but the smart everything world and the alternative energy world. All those things are coming, all these big changes. And if you can wrap your head around change being positive, right? If you don't let it make you depressed, and man, I'm tempted to show you something. I saw a video yesterday on Twitter that me and a trader up in Montreal had a little fun with. So a guy that I know, and I think he was making fun of her. I mean, I hope he was making fun of her. You should really go to my Twitter feed. It's pretty entertaining sometimes. Apparently I was posting articles. Oh, well, I might have to scroll too far. So anyway, a prepper was getting interviewed, and I'll tell you, um, all of the stereotypes about preppers was encapsulated in this one woman giving an interview. Oh, here it is. I'm getting closer, but it is on David Modell's thread, and you should watch some of the interviews this guy does. Some of the interviews he does are just outstanding, and he doesn't believe in all this stuff. Oh, here, this is it. Oh, this might be it. Oh, look at her eyes. Look at her eyes. All right, I'm sorry. I shouldn't be being mean to people, right? But I watch some of these things, and my head starts to explode a little bit because I have a hard time understanding how people believe this stuff. Look, the world's going through epic changes. That's true. Is there going to be financial disruptions? Yes. Are we going to starve? No, there's so much food on the planet we don't know what to do with. It's just that when we send it to a country that needs it, somebody steals it. Look, just get ready for the changes and have a common sense approach to how this stuff works. Learn the financial aspects. Understand that the financial industry is out for the financial industry. That's what I'm trying to bring to this service. That's what I try to bring to my investment advisory. Look, I know that I go out to New York. I just was interviewed on the floor of the New York Stock Exchange. Look, New York is about New York. The Wall Street guys. Now, do they do a lot of great things for the country? Yeah, they do. Do they make sure they get paid well? Yeah, they do. Do they cheat on their taxes? Yeah, they do. Do they buy politicians? Yep, they do that too. Do they cause a financial crisis every so often? Yep, they do that too. So if you just accept what you can't change, at least not quickly, right? I mean, through voting and things like that, we can change it eventually. However, in our personal world, for me, I have two kids, 20 and 23 right now, who I know are starting off in a tougher environment than I started off in. I started off probably in a little tougher environment than my parents started in because they were part of that whole big boom during the baby boomer era. But what's come back to the X generation is we have a lot of management opportunities, right? Because as the boomers retire, our group's smaller and we still have to fill those roles. So my generation's doing okay. But the millennial generation, they're starting out with lower wages, higher debts, and a slower growth economy, right? And dealing with terrorism, which, is bad, but it's really there's not really that much terrorism. Let's face it. We do a pretty good job with that, and it's become an industry almost. But the reality is the millennials, cut them some slack because they don't have it as easy of a path as the last 2-3 generations did. And so when you talk about them living in mom and dad's basement, that's really not a lot of them. They are buying houses now, and that is what's driving the housing market is the millennials buying houses. And the other thing to keep in mind is, and this is a fact, the millennials are saving on average double for retirement what the baby boomers did at the same age. So in this world of change, if we can have some empathy and we can understand that change is just what it is, it's change, and get on the right sides of those changes, right? So as this industry falls off and this one picks up, where do we want to be? Out of that one, in this one. As we see the price of oil going up, where do we want to be? In it or out? We want to be in. Are we going to be in there forever because it's a forever thing? No, it's not a forever thing anymore. If it's not a forever thing anymore, what's coming next? Alternative energy. We need to have exposure to solar. We need to have exposure to the smart grid companies. We have to have exposure to the IoT companies that will connect all this stuff. So this is not the end of the world like some of these preppers are talking about. It's just the world changing, and you need to adapt, right? Adapt, survive, thrive. And, I wish I could tell every prepper out there, hey, it's great that you have that contingency plan, but really if you just did a few other things and were a little bit more laid back about the world, it would probably work out for you. All right. Any more questions? More books about technical analysis? I not really. No. Go to stockcharts.com. If you want to learn technical analysis, everything that you need is at stockcharts.com. I use this website all the time. I don't really publish much off of it. Can't remember the last time I used one of their charts. Yeah. And I don't think, it's not a cheap service. Maybe, I think it's like $19 a month. This is what I would do. I go to their chart school, and this is what you want to learn. Okay, so just go to stockcharts.com, get a cheap subscription if you want, and, learn it that way. But really, the stuff that I'm doing, between using this quant system that throws out some ideas, and this one's cheap too. But the thing is, I don't use their list. I don't even look at this all the time. My portfolio. My watch list. It's not loading in. I have a whole huge portfolio in here. Maybe it's over. Oh, there we go. Well, in any case, so, this is a quantitative system. It's a ranking system. I can use it for finding new buys. I can find it for breakouts, stocks that are spring loaded. This is my favorite one. Put selling, companies that are ripe for put selling. I use this all the time. So what you're getting with my service is basically all this. I subscribe to all of these and more. Stansberry, I basically just wanted to see how they market. There's like no value in their ideas, but they are a marketing machine, and I wanted to learn how to do it. But ETF database I'm using, foreign affairs, foreign policy, FinViz, Hedgeye, Market Trend Signal, Morningstar. I've got all the top stuff, and there's more. There's certain. I just started reworking this, so it'd be easier for me to find things, But yeah, go to stockcharts.com if you want to learn technicals, and don't spend a lot of money doing it. Anything else? No. Can you recommend? Yeah. Biases are tough to overcome, right? So you need to put your ideology aside, right? I'm a pretty centrist guy. I criticize both sides, and I'm a pretty centrist guy. Here's a company that might end up on the short list, KKR. But they pay a nice fat dividend, and they're heavy in energy. But yes, biases, our blind spots, our ideology, our self-validation. All these are things that we have to do, right? It's part of controlling your emotions. I had this talk with one of the members yesterday, gentleman that I met out in Connecticut, a priest who is a member, and I said, there's three things that are pretty much the three most important drives for a person. The first one is survival, right? The second one is procreation, right? Everybody procreates for the most part, not the priest, but survival, procreation, and the third one, I would argue, is self-validation, right? We all rationalize to validate ourselves. And if we can be introspective and catch ourselves once in a while when we're doing it, that's when you really make an improvement, right? So I went to a Catholic high school, and I'll just tell you a story here. I'll make this quick. I went to a Catholic high school, had a teacher named Mr. Pauly, and had a few classes with him. One was a justice and peace class. I forget what the other one was, but I know that we talked about growing up and what type of person you wanted to be and having a code. It might have been the justice and peace class. I don't remember. A lot of funny stories, flood in from that class. But I made a decision in high school about the type of person I wanted to be. I wanted to have a particular ethical code. I wanted to have a high ethical code, to the extent that it even supersedes the law at some point. You got to be very careful and select on when you give yourself an exception. And I haven't really done that, but I could see circumstances where I would, that involve my kids or my family or something, or a very, very close friend. However, you want to have a very high ethical code. I try to have the highest one. Most people are in the middle. I wanted to be a Renaissance man. I really enjoyed reading Ben Franklin, where he knew a little bit about everything. And I have followed that path. And now I'm at a point where I'm an expert on probably 4 things. And, I'm trying to make myself into an expert in a 5th thing. But that takes years. So I'm a year into becoming an expert on alternative energy and smart grid and smart everything stuff. It's going to take another year or 2. It's just, there's so much to learn, and it's always changing. But by being introspective, where you are in a process, whether it's a relationship or learning something or accomplishing something or building something, whatever it is. And what I've gone back to a number of times, and I think this is in my biography or something I wrote, is my first landlord. My first landlord told me, learn from people who have done it. Don't go to your bartender, your hairstylist, your friend, unless they've done it. If you have a big question about how to do something, go find a person who's doing it and figure it out from them or ask them. And that's what I've tried to do my whole life. And I've brought that to this. I'm not a lone wolf on this. I've got all these subscriptions, and then everything that's through the 3 brokerages. I have accounts at Schwab, TD Ameritrade, and Interactive Brokers, and they pile research on me. So ultimately, I'm just a funnel, right? And I think I have pretty good judgment, at least in this regard. I don't want you to talk to ex-girlfriends or anything, but the reality is that none of us can be superstar traders. None of us can be superstar investors without help. And that's what I'm offering, is some help with this stuff. And we've made some great trades already. The volatility trade was good, but some of the investments are going to work out even better. For those of you who are with me at Fundamental Trends, we made 1,000% on Exact Sciences in 18 months. If you got in at the bottom, and even though we had some volatility, the option trades were spectacular. So there are those occasions where we can make a lot of money in a year or 2. But the reality is the way this will play out is you make a series of small decisions that are good, and some of them will turn out to be great. And that's the Peter Lynch thing. You make a bunch of good decisions. You have your 20 or 30 stocks and a few ETFs if you're going to build a really full portfolio, although having a dozen stocks and a few ETFs is good for a lot of people, for most people, until you're well into the 6 figures. And if you do that, you build your portfolio carefully, a little at a time. You focus using some stocks, your best ideas, and just stick with your best ideas. Skip anything that you think is a good idea, and only include the ones that you think might be great ideas. You can find a dozen of those over time. And then, you build a good asset allocation using ETFs. They're cheap. They, a little bit extra energy with XOP. Maybe we're going to buy some Mexico soon. That's a hint. We're going to buy some Mexico soon. Maybe some Brazil, maybe some India, maybe some Vietnam, right? Some of these countries that are going to do well over time, if you find them during a correction, you get there during a correction, you're gonna make some money. Something else that I talked about with Mike, Father Mike, yesterday is the gap in earnings. That's where stocks get beat up, is when they are in some sort of business transition or they lose a big customer and they have to, shift. Take a look at Micron. Take a look at Sierra Wireless. These are companies that had a transition period. Sierra's in it now. Micron had it a couple of years ago. I was telling people to buy Micron when it was $10, $12 a share, and now it's 50. So a reason why I don't really pound the table on Micron is because I know that the easy money was down when it was 10, 12, right? The journey from 12 to 50 was the easy money. The journey from 50 to 100 is the hard money, right? Because that's I think that's going to happen, but it was easier to get from 12 to 50 than it is from 50 to 100. So with Sierra Wireless, now that it's down 50%, why is that happening? Sierra Wireless, and again, I've talked about this already on Seeking Alpha, so I'll throw this idea out there. I know most of you own it already. They had that gap in earnings, right? Because they lost some OEM business, but now they're moving into the cloud-based business, and their growth rates there are huge, but hasn't quite offset the loss in OEM business and the delay in some of the implementation, right? New technology sometimes gets delayed because of budgets, because of scalability issues, whatever. Sierra Wireless is going to start surprising to the upside third or fourth quarter, maybe, and then for sure next year. So you're going to see analyst expectations start to get raised into the end of the year. That is what Zacks Investment Service is based on. That's why I don't subscribe to them. I know how their system works. If I can get in, but I do subscribe to Tip Ranks, so I can just keep track of the analysts myself. But so if you want to spend money on something that'll really, I think, give you some good insights, I actually do recommend Tip Ranks. I think Tip Ranks is very interesting, so that you can learn what the analysts are really saying, because you can't really get that research anywhere. But if you know what they're all saying and you can start building your own little spreadsheets on what the analysts are doing, what you'll see is that the analysts all love a stock when it's up here. They're raising their estimates. But when a stock gets beat up, they don't love it anymore. Where should you love it? Right? Did the fortunes of the company really change in this quarter? No, something got delayed. I don't know what it is. Something got delayed. But KKR came down from 24.5 down to 20. It was a sell, momentum sell, turned around. Now it's a hold. So it's moving from negative to positive right now. As it goes up, right around here, it'll be considered a breakout. So from 20 to 23, that's that area where you have to make a decision. Do I want to be involved? Because could it go back down? Sure, it could. That's where your fundamental analysis comes in. So maybe I buy a little bit here because it's broken its downtrend, right? I didn't want to buy it in here. Downtrends, just stay away from the downtrends. Wait for them to turn, get back in that neutral range, buy a little bit. And if it goes up, especially as it starts to break out, add. And if it goes back down, hold, wait for the downward momentum to be broken again before it turns to yellow and get neutral again, and then you add again. This whole buying on the dip thing, people do it wrong because they don't even consider these are quantitative signals. This is based on largely on cash flows into and out of the stock. So, that Chaikin ratio that I show you once in a while is a similar thing. And I'm sure it's built into this. And actually, I know that it's built into this. When you average down, don't just pick random spots. You have to wait for the downward momentum, right? For the falling knife to settle. Doesn't mean you can't drop the knife again, but you wait for the falling knife to settle and, get a little bit of confirmation that's moving into, a consolidation and accumulation phase. And then you start adding. And then when you get towards the breakout zone, I mean, that day that it breaks out, if you can catch it that day, then, sometimes you get one of those great big candles up versus a candle down. So you get a big candle up. So, that's how you scale into and out in very simple terms. And that's what I've been doing. Since I really formalized the core four, right? And I'm gonna finish with this. Since I formalized this, I always was a top-down guy just because I find it super interesting. And I've always known don't fight the Fed. So I've always known don't fight City Hall, right? And then fundamental stuff from, Peter Lynch, Warren Buffett. When I added the price trend analysis, right? Because as a broker, they don't want you doing this. Why don't they want you doing it as a broker? Because it interferes with you selling stuff. They don't even want you they don't want you doing any of this. When you're a broker, they just want you selling. They don't want you to even bother with any of the actually knowing your investment stuff. But when I added the price trend, and I started adding it in 2007, because I was pulling out of the market back then, largely based on what some of the trend followers were doing, the turtle traders and guys like that. But I really formalized this in the last couple of years because in 2015, I just took it on the chin. Everything I put money in went the wrong way. And I had an epic bad year in 2015. Now, last year, you saw I published my results. A verified from the brokerage 48% return last year on an average count. I credit because I think I'm getting better at all this stuff, but adding this component, the price trend analysis, respecting investor psychology for entries and exits is just monumentally important. So somebody actually asked here about psychology, and I'll put something in. I'll find something. I have a whole shelf of books here. I don't even know which ones I would consider my favorites anymore. A book just on human psychology, on negotiating emotions, would be Beyond Reason. I strongly recommend the book Beyond Reason. Since I read that book, my income's gone up. My personal life's gotten better. My professional life's gotten better. It talks about the 5 things that we all need. And those 5 things are autonomy. We want to make our own decisions, right? That's why you're a do-it-yourself investor. We want appreciation, right? Millennials want a little bit of extra. Everybody wants to be affiliated with something. Everybody wants a role in the thing they're affiliated with. So if you want to roll with margin and safety investing, you want to write a quick thoughts, just send it to me. I'll post it. I'll incorporate it with something I'm doing. If you want to do a whole core 4 analysis, which I'm going to get the GE one out this week because it's time, and then that'll be the template. Great. And then the last thing is status. A lot of people crave status. They want to be called the boss in whatever form that is, the president, the CEO, the coach, whatever, the supervisor. That's the one that's tricky, right? Because if you thrive on being acknowledged as the boss, or the leader, if that's the most important thing to you, sometimes it takes over, right? We've all seen movies or Star Trek episodes where somebody gets power hungry, and that can be a problem. But in general, those are the 5 things that we emotionally revolve around, and that's where our self-validation comes from. That's where the rationalizations that we make come from. So if you want to read a book on psychology, yes, Beyond Reason, using emotions as you negotiate. And it's not just negotiating a business deal. The first chapter of that book is about how they got a peace deal, the Camp David Accords, between Egypt and Israel. That first chapter is just amazing. That's the guy who wrote the book was part of that deal. So, I think if you're going to read a book, read Beyond Reason. I'll try to send you an affiliate link so I can get like 17 cents or something out of it. Let's see here. I have the tendency to not cut short my losses. Yeah, we've all done that. I did it in 2015. 2015, I'll tell you, I got my only complaint out of 2015. 20 some odd years in business, I get a complaint. Now, had she waited, she'd have made everything back quickly. But regardless, I had to deal with it. And here's what happened. So I got a permanent leg injury playing baseball. It's not serious, but it's there. I got hit in the heart with a baseball from a different diamond. My heart stopped. I was in the hospital. That was a messed up week. And then my house burnt. And I'll tell you, I don't wish anybody in the world to have their house burned because it is a traumatic thing. And I woke up after being back in the house after 4 months out, got back in. 3 months later, I wake up on the couch, having not slept in my bed in the 3 months I've been back in the house, looked at the Christmas tree, and the first thought in my mind was, I hope that doesn't start a fire. Second thought was, why am I sleeping on the couch? So, when you get divorced and you have kids, they make you go see a psychologist just to make sure that you can raise kids, I guess. And so I called that guy. I said, hey, I think I'm depressed. And I got in there. I wrote him a note. And he goes, you're not depressed, you're angry. And he said, if you want to build something, you want to rebuild your life the way it was, or you want to build it differently? I said, well, don't really like the way my business was going. I was going from a small business to a medium-sized business. The thing is that medium-sized businesses suck because you're putting all that capital back in and you're building so you can become a big business. I said, I just want a little business, and then I want to publish and do research. He said, build it that way. So that's what I've been doing for a little over 2 years. I now have 260 some odd subscribers. It's almost a full-time income. I still manage $7, $8, $9, $10 million. And I'll run that up to 20, 30, 40, 50 million over the years. But I'm doing it one client at a time. I'm not taking 10 clients. I don't market at all. The only marketing I have is what I publish. If you don't read my stuff, you don't know I exist. And I like it that way because people who do call me have vetted me by reading my stuff and following. Every client that I've brought on in the last year, and it's like 2 a month, 3 a month, they've read me for a long time, right? People from MarketWatch, I haven't written anything for them in a year. People from MarketWatch still call me. Hey, reading you on MarketWatch, I found you again on Seeking Alpha. Can you help me with something? And I do a lot of consulting, for do-it-yourself investors, and I like that business. So, all these things come out of emotionally how we behave, how introspective we are, where our ethics are, and what we are trying to achieve in the long run, and that translates directly into how our portfolios work out. All right, hedgies are going long Russia. It's a high-risk trade, but I understand the value proposition they see. I do. I'll probably put it in there as a speculative investment because with oil going up, I think Russia could do really well. You're talking some important. All right. Should we still buy hedges listed in your April options? Well, not yet. Remember, so the S&P 500, the SPY put, that was a super cheap price, right? We're not anywhere close to that price yet. So it's not time to hedge. I think we're going to get a rally. You hedge after a rally starts to peter out, when the options get real cheap. They're not real cheap right now. So there's not really, you can't get any of those. You can't get any of those for those prices anymore. Now, I guess a couple of them are about to expire, so those shouldn't count, right? If anything's about to expire, you just ignore it. But no, I don't think there's any reason to hedge anything right now. I think your best hedge is to have a little extra energy in your portfolio. My IWM hedge was executed yesterday. Okay, well, first of all, don't ever allow an option to get executed. So you had, what did you own there? And you shouldn't be trading options if you don't quite understand it yet. You should be studying. So you bought a put You have to tell me what you did there. Anyway, all right, which of the energy plays look best at the moment? I think if you're a dividend investor, very hard not to own Occidental Petroleum. I think if you're just looking for the biggest bang for the buck on growth, Encana's just sitting there. It's just waiting to explode upward. I bought the IWM put. So now you own IWM at a certain price, and you realize the loss, is my guess. Or did you make money on that? Yeah, so you probably just want to sell the IWM that you now own. Although if we're gonna get a rally, you probably just hold on to it for a little while. Yeah, send me a private email and we'll talk about it. All right. Goldman Sachs. Somebody just raised. Was it Goldman Sachs? Well, somebody just raised the price target on Encana to 14. So the world's going to start figuring this stuff out. The energy companies, one of the things I'll talk about this week, the energy companies are going to start putting out monster profit numbers. You're going to see their cash flows going through the roof in coming quarters. And if I'm right and oil goes to 80, Katie bar the door. Some of these stocks will double. I think Encana is going to 20 or 30 for sure. So that's why I own calls. I own leaps on Encana. All right, this has been a long call, and might have to break it up into a couple pieces to get it on YouTube. So have a great weekend, and I will keep you informed on Las Vegas. I do have my last tournament in that league Saturday night. If I win the tournament, or maybe come in second, I win the league, which is a little extra money. But I have actually already won the seat in the Monster Stack, and we're running an online series, and I'm winning that one too. I've won half the tournament so far. So, and I'll tell you, it's a good league. Half these guys could be, fair. They could make part-time livings at least off of this. I do it for fun, but if I accidentally win $1 million, hey, that'd be great too. All right, have a great weekend.